Hello and welcome to the Financial Synergies Wealth Advisors webinar on structured notes. I'm Matt Oftenspring, Director of Marketing. I'm joined by managing partners Heath Hightower and Mike Minter. Great to see both of you today.
Good to
Good
see
to
you
see
too,
you.
Matt. Happy to be here.
I'm excited to talk about this subject of structured notes because it sounds very complex, and I'm glad you guys are here to really break it down, explain what they are and how they can fit into a long-term investment strategy. Heath, I'll go to you first. A big part of the financial planning we do here for clients is to design retirement generating income portfolios. Talk to us a little bit about how that works.
Yeah, well, I appreciate that, Matt. Thanks for the intro. And I'm glad we started off with the topic of financial planning because that really is what we do here at Financial Synergies. At heart, we are financial planners. And so when we design a portfolio to produce income, we start with the plan. And of course, there are lots of different ways to produce retirement income. We have a program that we call the retirement salary that is specifically designed to produce a steady stream of income for retirees to make sure that they, never run out of money and to make sure that the income that they're producing is tax efficient as it possibly can be. Back in when I first got started in the business, there were a handful of traditional ways that you would create income. And most financial advisors, most people kind of fell into the same philosophy. There's 3 or 4 different philosophies for producing income, and everybody would subscribe to one of those philosophies. One idea was to buy bonds, right? Buy a laddered bond portfolio. You might yield 4 or 4.5%. Another idea is a dividend strategy. Maybe you buy the S&P 500 or a value strategy that has a nice 2 or 3 or maybe 4% yield. Um, you can buy a money market today or a CD that has a 4% yield. But all of these strategies have one thing in common. The yield is just nothing to get too excited about. And so, as the world has changed, as the world has evolved, and the landscape of opportunities that we have as advisors has changed, we now have some highly sophisticated investment vehicles that we can bring into the mix to use as just a tool. This is not a replacement for the traditional income portfolio, not by any stretch. This is a way to enhance returns a little bit for some people. So structured notes are not in all of our clients' portfolios. Maybe less than half of our clients are in structured notes. But for the ones that are, they really like them. One of the great things about notes is that they have a yield that's significantly higher than we can get on the more traditional side. I was start throwing out some numbers of 3, 4% yields, which is fine. But the yields that we can get on structured notes are closer to 9, 10, 11%, sometimes 12%. And so I'm really excited about the opportunity to talk about these notes from a planning perspective, not just because they're an alternative way of producing income, but an alternative way of producing income that can be significantly higher than what we might have otherwise received.
Yeah, I think you made an important point, Heath. These are now available to us via some pretty advanced technology that really wasn't available in the past, although these notes have been around and financial institutions have been creating them for 40, 45 years. For the longest time, it was really reserved for really high net worth institutional type investors, not even really individual investors whatsoever. And now we have access to these things at a pretty reasonable scale. And we can, because of our buying power, we can aggregate client portfolios for fairly large trade blocks and get really, really favorable terms from these banks. And we're talking big banks, right? I mean, we're talking Bank of America, Goldman Sachs, UBS, Bank of Toronto. I mean, these are very large institutions that had the capabilities to really customize these things at a pretty large scale. And individual investors still can't purchase them on their own. They just can't. So we do have a pretty cool advantage there.
So I know scale plays a big part in this, Mike, and you and the guys on the portfolio management team spend a lot of time really structuring these notes, putting them together. Um, Tell me a little bit about how that process works. I know the individual, most of our clients might have $2, $3, $4 million. So the piece of of their portfolio that might go into this might be 50,000 or 100,000 or 200, so smaller
Sure.
amounts. So how do we? I'd love
Sure.
to learn a little bit more about that process.
Yeah, and I apologize. I'm not trying to come off like a divine being here, but my son is just blinding me through my window right
Looking
now, and I
great.
can't control it. So
Quite golden.
I
You're looking very golden today, man.
I apologize for this, but there's nothing I can do. But yeah, I mean, to your point, nobody's gonna, you got a $3 million portfolio. You're not putting $1 million in structured notes. We're talking. Let's say you're putting $50,000 or $100,000 as a complement to your bond allocation already. Again, this is not. I think you made the point, Heath. This is not a replacement. It's just a complement or an alternative that may not even be necessary. But let's say it's a $50,000, investment. That on its own is not going to get you the ability to customize a structured note on your own. It's just not. The banks won't really touch that. But if you're going in with a larger trade block that's, $3-4 million, that's substantial. And then you really get to customize the terms. So, we'll have a note that has certain terms and characteristics developed. And for those clients that meet those types of profiles and objectives, they will be allotted a spot in that particular note creation.
Yeah.
And that happens, let's call it on a monthly basis. We could even do it, more frequently, and we probably will in the future. But you're able to, quote unquote, tag along with a larger trade block that gets us those really favorable terms. So we're able to really price these out competitively, kind of bid them out. And that's what we do on every note. And we're going to fight to get the highest yield and best terms we possibly can on these things. And that's what kind of makes it exciting from our standpoint, but it also is an advantage for our clients for sure. Yeah.
That's I was just going to say that is a huge advantage for our clients. And another part of this too is that at a high level, these are tied to certain indices, right? So there's a level of risk here, but there are also some barriers in place to mitigate some of that risk. Could you guys talk a little bit about that?
Yeah, I'm happy to jump in there. There's no free lunch here. We're talking about yields that are very exciting, 10, 11, 12%. That sounds fantastic. So the natural question is, well, what's the catch, right? And there is some downside here. And so it's really important that we as advisors or investors go into this eyes wide open, because there's no free lunch. Notes can work in a myriad of different ways. There are lots
Sure.
of different types of notes, and we're talking about very straightforward notes that work very much like a bond. So if you've ever purchased a bond, you buy it at par, it has maybe a semi-annual payment that it makes along the way, and then it's redeemed at par, right? That's how a bond works. It has a CUSIP, and it trades every day. So there's a little volatility. The way that a structured note works is not all that different. You buy it at par, it has a yield that it pays out. In this case, usually it's monthly, and then it's redeemed at par. It's either called or redeemed at maturity at par, generally.
So
With a
you'd get
few,
all so you'd get all the stated interest payments as long as there's an underlying asset basket that I'm sure you'll talk
yeah,
about. But as long as those stipulations are met, you're going to get all those interest payments. And to your point, you get all your principal back at maturity, which is exactly like a bond. It's just that there's this underlying basket component.
yeah, and there are a couple of contingencies in there. And the contingency is how well the market does. So the note is based on the market or a basket of markets. And if those investments are down, and in our case more than 30% or sometimes 40%, then the coupon would not be paid. And so it's contingent upon the market not losing a ton. We structure our notes to be very conservative. There's a 30%, sometimes 40% downside protection. And we've never had a note miss a coupon or mature below the barrier. There is a risk of that, but it's a risk that we're willing to take. And so what we're able to do when we design these notes is go into the note eyes wide open and understand what the risks are, and we'll understand what the probability of failure is. Some people call these defined outcome investments, which means that we're defining the outcome. When you buy a stock, the range of possibilities is essentially endless. It could go up 1,000%, it could go up 5%, it could lose 100%. We have no idea what's going to happen with that stock, really. With these, well, we can dial in the probability of achieving that yield, that total return of 10%, let's call it. If we're trying to make 10%, we can design a note that has about a 95% chance of making exactly 10%. And so this is a calculated risk. It's not a guarantee. It's a calculated risk. We know that we've got a 95% chance of making 10%. There's a 5% tail risk that the return is different than that. I think it's interesting if you go to Google and you ask Google about structured notes, you get lots of different stuff, lots of different opinions. I would say be careful about what you read out there. There's a lot of stuff that a lot of people love these things, and a lot of people hate them. And what I would say is structured notes, remember what they are and what they're not. Structured notes are essentially they're contracts. They're a vehicle that can be used to express a particular viewpoint of the market. And so the note is as good as the terms that are in it. So a note is not good or bad, just like a mutual fund can be good or bad, or a stock, the stock can be good or bad. There's really no such thing as a bad stock. There's just a bad stock price. There's no such thing as a bad note. There's just such a thing as a note with bad terms. And so we do a tremendous amount of work on the front end to make sure that the terms of our notes reflect exactly what we need it to reflect. And in our case, we're really focused on getting a respectable yield, which in this world is about 10% or so, with some downside protection, usually 30 or 40% downside protection. And if we can do that, then to us, that's a really good trade-off. Remember, when you buy into a note, you're buying it for the income, not for the growth. And so this is not for someone that's looking to make all of the upside of the market. If you want to buy into the market to make all of the upside, you can do that with an exchange traded fund. This is not a growth vehicle. This is a vehicle to enhance yield and to produce income.
Yeah. And you made a great point, Heath, and I'll follow up on that too, where, a lot of the headlines, a lot of the articles you're going to, if you pull up something about, callable yield notes or structured notes, a lot of these kind of hair on fire articles will warn you that they're so risky and they're, this, that, and the other. To your point, the underlying asset of a structured note, this basket of indices that we've talked about, it actually can be almost anything. It can be a commodity. It can be one stock. It can be a very, very risky stock. So we've seen notes created around Tesla stock, for example, or NVIDIA, or things even on the smaller cap side where they bounce around like ping pong balls. And yes, I would say those take on a whole nother level of risk that we're just not really going to do. We create ours with an underlying asset that's a basket of very standard indices. So think the S&P 500, the Dow Jones, maybe the NASDAQ, maybe the Russell 2000. These are not high-flying individual stock positions or an underlying commodity that is just insanely volatile. Yes, I would agree that you have to go into these eyes wide open and really know what you're doing, but a lot of these articles you read, oh man, they created this crazy high-flying structured note and it did this, that, or the other. And more often than not, you read about the terms and you read about the underlying asset and you go, yeah, that does sound kind of wacky. I wouldn't have created that. So you do have to take those articles with a grain of salt. Again, there's no free lunch here. Risk is what it is. We understand that fully, but understand that a lot of these things are taken out of context because they say, oh, it's a structured note. Well, a structured note can mean a lot of things, and it's all dependent on the underlying terms and the underlying asset that you're basing it off of. So just important to remember that.
Mike, that's such a good point. And one other thing that I see when I talk to clients about notes is there is a kind of a fundamental misunderstanding of how the banks get paid on these things and how financial advisors get paid on these things. When they first came out, I believe the first note was in 1980. And over the years, they became sold almost like annuities. And so they kind of got a bad rap. They became very expensive internally. But eventually the investment banks started understanding that on the individual side, on the private side, the institutional side, which is where we are, we're not looking for the high commission stuff. We want very inexpensive investment vehicles for our clients. And so they stripped all that out. So now there are kind of two worlds in the industry. There's the advisory side and the commission side. And we're on the advisory side. It's almost like buying an index fund that has very, very low internal cost to get exposure to these strategies. It's a very low cost way of accessing a highly sophisticated investment vehicle that can produce a nice yield.
And I think too, just even above that, yes, they're low cost, much like you'd find in a low cost index fund or mutual fund. But beyond that, we, at the end of the day, we are a fiduciary firm. We are only paid by our clients in terms of, our percentage of assets under management. That is it. There is no commission whatsoever on a structured note. It's no different to us than purchasing an exchange traded fund for our clients. There's no financial incentive whatsoever for us purchasing these types of vehicles for our clients. So just at the high level, that fiduciary standard is absolutely in play here, no matter what we're purchasing.
I guess one other thing that might be worth talking a little bit about is liquidity. You'll read online that these are not liquid, and technically that is the case. So when we buy a note, we intend to hold it until it matures or until it's called. And these things are called quite often, which is fine. It's not a bad thing. It's just fine when a note is called. We just reinvest the proceeds. But it is technically illiquid. So what that means is there's no secondary market for us to go sell these things on an open market. Oftentimes we can sell them back to the investment bank, but we have to go to them and negotiate that. So the idea is that we hold these long term. It is not something that's intended to be traded for liquidity. It's designed for income. Remember, when we sacrifice liquidity, we would expect what we call a liquidity premium, which means we expect to make more because we're sacrificing that. In this case, clearly we're making more by sacrificing some liquidity.
Yeah, and then honestly, it's not unlike any other investment we make in terms of our mindset around it. Yes, there is that illiquidity, but it's like anything else we purchase for a client. The idea is that we're not looking to get in and out of investments on a short-term basis. It's just not really a part of our long-term investment philosophy. So just from our philosophical standpoint, that's no different for us. But yes, the vehicle itself would lend itself to less liquidity. So absolutely right. Got to go into that eyes wide open and understand that that's going to be the mindset around these.
Heath, Mike, I just want to thank you for your insights. That was amazing.
Yeah, this was a lot of fun, Matt. Thanks for putting this together.
Really
Always
appreciate
like
it.
nerding out on investing. It's pretty cool.
That's what we do here. As you know, if you're a client, reach out to your advisor to see if structured notes are right for you. And for a deeper dive, we actually have a blog post all about structured notes that Mike authored. It's at our website, finsyn.com, and we thank you for watching.